not asking somebody for a raise, not being upset with the place you're at, but how do I create more income and more economic life value? What can you do as a person?
We're not talking about your intrinsic worth as a person. Your value as a human to your family, etc., is not measurable in dollars, but you do have a definable amount that you can be insured for, your asset value. That's called your human life value.
That means you have 40 years of working in front of you, 40 years in front of you to earn income. Let's say that 25-year-old earns about $100,000 a year. You are expected to produce $4 million of economic benefit or income in your life until you retire. And that's at a minimum.
If you're making $40,000, is it easier to increase your income or to decrease your expenses?
The number one asset in your life is you as a human being. So invest in yourself.
Everyone listening to this likely has full insurance value on their home and their car, right? On their property. Your life value is by far the more important of those two values between life and property. More than likely, you're a McLaren driving around insured like a Corolla.
We think that there's actually, as a father and as heads of households for us and many of our clients, it's our moral obligation that if we die young or anytime we die, even if we're old people, to make sure that those we love are best taken care of. So the plan for me is that
All right. What is going on, Brian?
Nothing, man. What's up? Ready to rock here with another one?
Yeah, this is a good one. This is a topic that we are both passionate about and everyone should be passionate about because we're going to talk about what are you worth. We're going to go through the concept of human life value. And before that, what's new in Pittsburgh?
Oh, it's baseball season, man. Baseball and soccer. Every evening is go, which is awesome.
Yeah, I'm not there yet. 3-year-old and 2-week-old. So we're still tumbling around in the backyard and digging in the dirt in princess dresses. So
the baseball side, the Pirates suck again. So at least that's normal.
Yeah, that tracks. I can see Petco Park, the Padres Stadium from my house, but I haven't made it to a game yet. It's pretty tough to manage nap time and 2-week-old. So I don't know if we'll make it to a game at some point this season, but haven't yet.
Take them when the Pirates play, they'll definitely fall asleep.
Padres aren't that great either, but the stadium is awesome. You said that PNC Park is the best in the country, but until I've seen it, I'm going to say Petco is.
We'll have to make it to each of those parks together and figure out, and then whoever's wrong can buy all the beer.
Yeah, sounds good. Well, we're going to need a lot of money for stadium beers. So what are you worth? We're going to talk about how an insurance company values you and how you should value yourself. Off the bat, we're not talking about your intrinsic worth as a person. Your value as a human to your family, etc., is not measurable in dollars, but you do have a definable amount that you can be insured for, your asset value. That's called your human life value, also called the economic life value.
And I prefer the term whenever I talk to people about this as economic life value, because I think as a Christian, we're made in the image of God, and that's our intrinsic human life value. Is it really doesn't have a price tag or value, but economically, we can say what we're worth to our family and to the greater economy as a producer.
Yeah, absolutely. And we'll use economic life value moving forward to make that distinction. Previous episodes, we've talked about how your ability to produce income is an asset. It is, in fact, your most valuable asset, most likely, unless you own a huge business. And that is insurable just like any other asset that you have, your home, your car, your personal property. Very likely you're insuring all of those things. Some of those, like auto insurance, you're government mandated to have, and other ones you're bank mandated to have a mortgage. You need to have insurance on your value, on your home, up to the value of the property. And so we want to insure our economic life value, our ability to produce that income, to the max that the insurance company will value us at, because that is what we are worth to our families if we have to put a dollar amount on it.
Is that an easy thing to do?
It actually is pretty easy. It doesn't sound like it would be, but it is pretty simple to get at least a ballpark of what that amount is.
What do you think you're worth?
I can tell you how much I think I'm worth by looking at how much insurance that I currently have. And we could look at any of our clients and we could see what they have, what they're covered for. If they were to walk off this earth tomorrow, hit by a bus, what are they leaving behind in the form of insurance? Because that is what they objectively decided that they were worth in a dollar amount. So we know the answer to that question of what a client or prospective client is currently valuing their life at in a dollar amount.
And that's probably not anywhere near, for most people, what an insurance company would say their ability to produce income is worth, is it?
Yeah, just about everyone we talked to, ourselves included when we started, fall well short of our maximum insurability. My first 10 years in the Navy, if you had asked me if I had life insurance, I would have said yes, because the Navy has a $400,000 group life insurance. It's now up to $500,000. But I would have said, yeah, my wife is going to get a check for $400,000, so I have life insurance. We're going to talk about how we actually calculate that and how wildly off the mark I was, and a lot of our clients are when they first get introduced to this concept. So Brian, if you want to walk through how they calculate it,
Yeah, let's actually talk about how the insurance companies on a base level here would figure out what they think your economic life value is. And very simply, what they would do is they're going to say that the normal working years is up to age 65. So there's a chart where this will fluff a little bit, but you can make the case with the underwriters with a nice cover letter or some communication. So if I take your age, if you're 30 or if you're 25 for easier math, and I subtract that from 65, the point at which they assume you're going to retire, that means you have 40 years of working in front of you, 40 years in front of you to earn income. Let's say that 25-year-old earns about $100,000 a year. We'll stick with easy numbers, just round good, easy numbers. If they're making $100,000 a year right now, which is the only evidence we have, we don't know what inflation is. We don't know what future raises are going to be. We don't know all these things, but we can say right now they make $100,000 a year. So we can expect them to make that for the next 40 years. Simply multiplying those numbers, 40 years times $100,000 per year, means you are expected to produce $4 million of economic benefit or income in your life until you retire. And that's at a minimum. So the insurance company is going to look at that and say, okay, we will max insure this person up to $4 million of death benefit. And very few people we meet have that max insurability covered.
Yep. And your standard military pilot is probably pretty close to those numbers coming out of flight school. I would guess when I was 25, that number was pretty close to accurate for me. So if we use that example and I was insurable as an asset up to $4 million, and then I tell you that I was actually insured for $400,000, I would have left my wife a small percentage of what I morally believe that I owe her because I provide for our family.
That's a 90% deficit.
Yeah, I had no idea. I would have told you I was insured my entire career because I knew better than whole life.
Now, the other side of that calculation is that's talking about income, is there's also, they will also look at the number of assets you have. So if you've built massive assets, or if you've inherited a lot of assets and you have, let's say, commercial real estate property that is worth $10 million, but your income level doesn't equate to that $10 million, they will insure you up to the maximum for your assets as well. So there's two ways that the companies will calculate your human or your economic life value.
And to expand on this, Brian, when we say that 25-year-old, and for instance, in the military, again, because that's both of our experience and a lot of our clients, that 25-year-old making $100,000 a year, do we expect his income to stay the same or to go up over the course of his career?
I expect it to keep going up for the rest of their lives. As a matter of fact, I think that any point in your life, unless you're maybe within a year or two of stopping work or retiring, you're probably at the lowest income level you will ever be for most people.
So following that logic, this 25-year-old's insured for $4 million. That's the most he can get at the time. But is that what he's going to leave to his family if he works until he's 65?
No, it'll be much less than that because he's going to continue to earn. And even if we just look at an average of, let's say he's in one job, never leaves it, does the old-fashioned factory route that doesn't really exist anymore, gets a job and stays in it his entire life, he's probably going to get on average a 3% raise every year. So when you compound that, by the end of his working career, he's going to be at least, I don't know, I didn't do the math, but at least doubling his money over some years. So it's going to fall far short over time.
Yeah. So that current economic life value, even if you max out, is probably low of what you would have actually brought in. And so not only are people underinsured to their current snapshot economic life value, but that number itself is short of what you likely will provide for your family. And that's why it's so important to capture the maximum amount of insurance that you can so that you at least hit that economic life value and then continue to expand as that number grows with your income.
Yeah, absolutely. And we'll show in the show notes some charts and calculators to show how companies figure this out.
Yeah. So to go a little more academic on this subject, there is a book called The Economics of Life Insurance by Solomon Huebner. He was one of the pioneers of the study, the economic study of life insurance, beyond simply being in the way that people think about it, just a gift you leave to your beneficiary. It's actually an economic science. It's a very definable mathematical, actuarial value production in your life. And so he really codified that and is considered one of the fathers of the academic study of life insurance. I've got the book right here. It's about 100 years old. You can see the price tag of $1 on there back however many decades ago. This was first sold at a yard sale. But right now, it's so hard to find that book. I scoured the internet for months until I was able to finally get a copy. But a couple great quotes from there on the economic life value. One of them there's Brian's copy right there. One of them that I want to read He says, life insurance is concerned with the organization and management of the economic value of human lives. That value may be defined as the capitalized monetary worth of the earning capacity resulting from the economic forces that are incorporated within our being, namely our character and health, our education, training, and experience, our personality and industry, our creative power, and our driving force to realize the economic images of our mind. That's a lot, but what stands out to you in that, Brian?
Oh, it's the right there in, well, I guess it's in the second sentence. Capitalized monetary worth. I'm going to reread this part slowly. Capitalized monetary worth of the earning capacity resulting from the economic forces that are incorporated within our being. So I think what he's saying here is the value that we as a human being, based on all of our background, who we are, our personality and character traits, brings forth and is going to produce basically our future income.
And whatever you're doing for income right now is a sum of your skills, your talents, your ability, your work ethic, all those factors that he mentioned. Those are all inputs, and the output is your current income in this equation and how we figure this out. And so all these factors of who you are, everything that makes up who you are is outputting a value, and that is your current income. That's the number that the company uses.
And if I can go on a slight tangent here, because I just think that's something that is so important, something that's changed in our lives and is mindset, right? If you are not happy with what your income is, what is the best way to change that? I think it's to change who you are, whether that's through training, through self-education, through changing your mindset, creating new skills. All of those things are what's going to determine the income you produce. And so if you're stuck, it's all about your mindset, and all of those internal inputs are what need to change. Not asking somebody for a raise, not being upset with the place you're at, but how do I create more income and more economic life value? What can you do as a person? Anyway, we can go back to the topic. It just
that ties in well to the idea that Brett Tanner put out in his podcast, Be Wealthy. If you're making $40,000, is it easier to increase your income or to decrease your expenses? You can't trim much down from that $40,000, but you can go from making $40,000 to $100,000. Many people have done that. And so all these inputs we talk about that he lists here, character, health, education, training, experience, personality, creative power, all of those factors can drive up your income to increase your economic life value. And that should be our goal.
So I guess for that person who's making $40,000, $50,000 and wants to increase their income, what are they better off investing in? A rate of return that everybody gets so worked up about, or themselves?
Yeah, absolutely. Yourself. You can take your income from $40,000 to $100,000. That has been done over and over. Comparing that to a 6%, 8% rate of return, there's no question. And when we take that increase in income and extrapolate that out over the course of your working life, that additional income that is going to be coming into your life increases that total asset value called your economic life value.
Which is just the fact that you are your number one asset. Your ability to earn is your number one asset in this world. It's not a stock market. It's not a piece of rental property. It's not even whole life insurance. The number one asset in your life is you as a human being. So invest in yourself. Anyway, we can jump back in, man.
Next quote gets to how and why we want to appraise our economic life value. Huebner says, the capitalized worth of the earning power of life, when properly appraised, is an economic asset just as truly is appraised property. If we choose to apply indemnity contracts to our property possession, it follows even more logically that we should be equally sensible with the monetary value of our lives, especially since that value constitutes the only real business worth there is for the overwhelming majority of family heads, the 95%. What do you take away from that?
Man, he's tough. The capitalized worth of the earning power of life, when properly appraised, is an economic asset just as truly as is appraised property. So again, it's the fact that you are your greatest asset. I think it just comes back down to the same thing. Do you have a different take on that?
I think the point there is that, again, getting back to the fact that everyone listening to this likely has full insurance value on their home and their car, right? On their property. And very likely, yeah, you have to. And very likely that same person, that same listener also is highly underinsured on their life. But the point he's making here is that your life value is by far the more important of those two values between life and property. Your life value, again, going back to all those factors that determine your economic output, that's the cause of the values of other properties. Your car is only worth what it does. Your home only has a sale price if someone's willing to buy it, right? So the interaction function of people in the economy based on everyone's individual needs, desires, preferences, and their human capabilities and traits. That is the driving force of the economy, but it all comes back to human life value, that economic life value that you have. Without that, there is no property value. There is no, your car is not worth any more than just a bare minimum utility, right? But we insure these utilities to the max, but our life, which actually provides the value that from which all other values stem, is grossly underinsured.
And I think to try to put that a little bit differently is without your ability to produce as an asset, as a person, your economic life value, you can't buy that car. You can't buy that house. So all of these property things that we have, all these things we own and we accumulate and pile up in our houses and everywhere else is all created because of what we were able to do to purchase it. Yet we insure all those things, but we don't insure the things that created or we don't insure ourselves the thing that was able to accumulate that stuff. Yeah.
Yeah. So if I give you a quote here, tell me what this means to you. More than likely, you're a McLaren driving around insured like a Corolla. In the light of the previous paragraph from Huebner that we just went through, what does that quote mean to you? More than likely, you're McLaren driving around insured like a Corolla.
Yeah, I love it. And we've said stuff like this to some of the members in our practice and people we've talked to multiple times. And it's awesome because it's the truth. Most of us are a high performance car that are pretending like that are insuring ourselves at the value of a throwaway car, a bottom of the market car.
Yeah. So if you had a Corolla, could you go get it insured for $200,000?
No, they wouldn't even write that. That would be absolutely ridiculous. The company would laugh at you if you tried to get more than, I don't know, 40 grand, 30 grand, whatever a Corolla is worth. That's the maximum you're going to get out of it is 30 or 40 grand.
Because otherwise you'd be incentivized to total it. And that's why you can't be overinsured. You can only be insured up to your value.
On the flip side of that coin, if you had a McLaren, would you insure it for the price tag of a Corolla? I don't know what a Corolla costs right now, somewhere in the neighborhood of 30,000 probably. But would you insure it for that amount?
No, absolutely not. Because at that point you get a fender bender and it's gonna cost more than you're insured for. So again, if you're a McLaren driving around insured like a Corolla, you're leaving this problem to your family down the road. You are not insuring the asset of your income production, which is for almost everyone much higher than they are currently insured for. And I believe it's James Nethery who says it all the time. But if you want to feel the rush of being underinsured, practical way, cancel your car insurance and then go drive down the highway and see how terrified you are because you realize that you are totally exposed. But we are, as a society, doing exactly that with our lives.
And isn't it crazy? Like just thinking about that when you just said that, I'm thinking about the fact that it is illegal to drive, at least in my state, and I'm sure everywhere in the United States, it is illegal to drive without insurance. And most insurance companies actually offer provision for underinsured and uninsured drivers. So if they hit you, you're protected on your own policy. But when you think about the legality of that, we've come as a society to say that you can't drive around without insurance in case you hurt somebody else or damage their property. And everybody accepts that. And they go, yeah, if you drive around without insurance, like you're creating a huge liability in your life. But you're in that vein, you're worried. They're doing that so you can protect strangers most of the time. Yet on our own side, we don't protect ourselves to best protect the people we're going to leave an inheritance to who we love. And so we both believe, we've talked about it many times, that we think that there's actually, as a father and as heads of households for us and many of our clients, it's our moral obligation that if we die young or anytime we die, even if we're old people, to make sure that those we love are best taken care of and that they're not worse off because of our early demise. Especially when the fact that, like, if they are, it's actually something we probably could have easily solved. It was just due to our negligence, our laziness, or for most people, lack of understanding. So I'm not getting on their case, but when you know better, now it's your fault.
Yeah. And if I think through it, I run the finances for my house. If I were to disappear today, I don't know that my wife could log into the checking account, let alone all of the different investment accounts we have, the insurance contracts. The management of our finances falls on me, and I'm very comfortable with that. Fortunately, I have a trust in place that details instructions on how those assets will be distributed, how my wife can access them, et cetera. But just think about, if you disappeared this second, would your spouse, and we're talking mostly to fathers just generally, because that's the bulk of our client base and our audience, but take that with your actual situation. But if you died tomorrow, if you died right now, would your wife know how to manage the financial strategy that you have in place? And so with that, you do have a problem, and that is that you are going to die. And when you do, we know that for certain. We know you're going to die. And we also know that there's a lot of vultures that are going to be ready to swoop in. And so that problem will be solved. It has to be addressed. But the question is it going to be addressed by you, or are you going to force your family to solve it in the midst of their grieving?
Yeah. So let's match that guaranteed outcome, death, with a guaranteed event, a payoff from life insurance. And let's do it to the max extent possible. Now, we get in the weeds on the human life value and getting your max insurability. You can actually even consider the fact that's all tax-free. So there's some people that think if my max number's way up here, I'm not going to be there spending some of that. It might come down. The point is, and there's a whole discussion around that, which I think we should have later, but the point is, can you leave your family in a place that they can economically move forward and live the hopes and dreams that you guys had, the lifestyle you had without you? Because I've had the conversation multiple times, more times than you can imagine. When you ask somebody about what they're insured for, do they have enough life insurance? They often say, I hear this often, and it's just a paradigm that most of us haven't been challenged on, is if I die, she'll be able to pay off the mortgage or she'll be able to pay for the house. And because that's for most people their biggest bill. And I often respond to that and I say, so are you the main income earner in your family? And especially if it's a yes, I follow up with so does your entire paycheck, do you just work to pay the mortgage? Is that why you go to work? Is that why you leave your family 40 to 60 hours a week so you can pay the mortgage at your house? Because when you die, if that's all you're worried about, what you're essentially saying or not thinking about is the fact that she's got to fill a refrigerator. They're grieving. She might want to take some time off work if she also works. Are your kids going to be able to go to college? How's she going to have a future vehicle? All these things that your income would have done if you were there, going on vacation, all the other purchases and events and experiences your family has. Can your kids continue to play this absurdly expensive travel baseball like my family does? I want my son to continue that. He loves it. Whether I'm here or not, he should have that opportunity as an 11-year-old boy to keep playing. Am I taking that away because I think that her only expense is the house? And then am I trying to make the future decision that is the highest and best use of the money is when you get this sum, let's say what you talk about SGLI, it's $500,000 a year. Oh, she can take that and pay off the house. Is that what's best for her? Does she need to make sure the kids are taken care of? Are there other pressing issues that maybe were left unattended before your death that when the government and the vultures and all the people come in, that she's going to have to figure out how to use that money to mitigate those things? So it's very short-sighted is all I'm saying. And we need to think about a big picture when we're thinking about protecting our families as heads of household, fathers, wives, whomever it is. Like, we really need to think about a big picture and the totality of the circumstances, especially while they're grieving.
Yeah, it's going to be a chaotic, tumultuous time already. And to add that burden when you don't have to, if you're listening, you have the ability to leave your spouse economically unchanged. You have that ability. Your family does not have to change their lives due to financial constraints. You objectively have that ability if you're currently listening to this right now. There is a problem that you're going to have to solve, and problems have a price tag. So when we're addressing this, when we're looking at setting up this system, we're going to talk through what is the cost of addressing this problem. Because again, someone's going to address the problem and pay that price tag. But the cost of doing nothing is a lot steeper than the cost of addressing it now. That gets back to all the discussion of inflation, fixed premium, et cetera. But even more so on a moral basis, what are you going to be leaving your family with? Are you going to be leaving them with the same lifestyle, security, comfort, and removing that financial piece from their grieving? Or are you going to dump that problem on them that you could have solved now? If you can't solve this problem now, how are they going to solve it in the future?
And some, like what you just said there, where you were talking about the cost of doing something now is versus later, it really brings me to that kind of 3-part idea. Is there's cost, there's value, and then there's return. And so most of us look at cost versus value. Those are the 2 metrics most of us look at. And we make a lot of decisions based on cost. But what's the value? And actually, if we even consider return, what's the return? Which, when you think about the fact that your family can continue for pennies on the dollar for all of those years, I'm 42. If I died right now, and by the world's idea or the United States' idea, I have 23 working years in front of me. If I died right now, that the value is that for pennies on the dollar, my family can continue the next 23 years when my kids are all grown up as if I was here. I can't. That's a massive return that I can't actually afford right now. I haven't been able to provide that kind of return that's going to ensure that length of time and their prosperity, or at least their comfort.
Yeah, and if you're listening to this now and you don't have a family, you're a young guy without a wife and kids, you're going to get those one day, God willing. And so you can fix this problem while it's even cheaper now. Just straight up, the younger you are, the cheaper this problem is going to be to solve. And you can lock this in right now so that by the time you have the wife and family in place, you're not making these decisions and trying to scramble to make sure that they're protected against all outcomes. A couple practical questions to ask yourself right now that will help you gauge whether or not you are on track with this concept of economic life value. If you die tomorrow, can your wife continue to stay at home and raise your children, or does she need to go back to work? Will your children maintain the same quality of life? Will your wife know how to navigate this financial strategy that you have in place and access these various accounts? If you do have a strategy in place to ensure your family's economic future for the rest of your life, how confident are you that strategy will last the rest of her life if you pass tomorrow, regardless of any market conditions, eroding factors, et cetera? Think about those questions when you think about how you value your life. Look at your current insurance picture, because that'll tell you what you actually, the dollar amount that you put on your life.
And yeah, and I mean, if you're not comfortable with some of those questions, it's worth thinking about it. It's worth talking about it, man. And even beyond, we've asked a lot of this is a little bit of a weighty discussion when you start thinking about the implications, of your graduation, as Nelson puts it, or of your death. But even when you consider the human life value, your death, what you leave, if everything goes as planned and you get to live a really long life, think about the generational wealth transfer you're creating. So the plan for me is that a few generations from me will be born into multiple hundreds of millions of dollars. And we're going to ensure that happens because I plan to live a long life and I don't have a lease on it. So I don't know when that's going to actually, when my time is up, it's up. But hopefully I get to live to be 85, 90, 100 years old. And all that economic life value that I built in my working years is still there and it's going to be transferred and it's just going to increase the Moody family wealth.
Yeah. If the answer to these questions are you're not sure or you want to stress test your current strategy, that's exactly what we do. So reach out to us, look for the link in the show notes and schedule a conversation with us and we can run through your current situation and see if you actually correctly value your economic life value. And if you don't have anything else, in summary, stopping a passenger on your family's financial future. Boldly take back control of your wealth. And we'll see you next time.
Yep. Looking forward to it. Talk to you later, man.